After my talk, you'll be like, they're wastes of oxygen who do this for a living.
Oh,
Everybody has beer, right? If you don't have beer, go get
I
beer.
have 358.
Beard?
No, no, beer.
I do not have a beard, I'm afraid. Sorry.
Delicious, delicious beverage.
All right, awesome. Well, I have the broadcast started, and Jen Ledbetter was asking which stream. I kind of panicked, and I started another one when someone asked me a question. So this is the right one. I'm glad you guys are all here. Welcome to Tea Time. And I've kind of broadcasted the link in 3 different channels. So we'll go ahead and get started. I know, Drew, you have to head out, and you've been waiting to get this presentation for about a month now. So we're anxious to hear. We have an interesting lineup. Talks about PyCon as well. So Drew, why don't you go ahead and take it away?
Sweet. So I can do a screen share then. Okay, let me see here. Screen 1. Yeah, there we go. What does that show? It just shows Hangouts, right? Can everybody see my little title slide?
I see your slide.
Yes.
Sweet. All right. So I hope I'm not the most knowledgeable person in the room here about this stuff. I hope that, because I'm a total noob myself, but I thought it would be fun to talk about options, stock options, and hopefully, I hope somebody knows a little bit more about it than I do, but if not, the talk is geared towards a pretty beginner level of understanding of all this stuff. So if you've never traded at all, you should still be able to follow along. And so if anything that I say, if I start using jargon that you don't understand or something, just stop me and ask, because I hope that this will be more of a conversation than like just a demagogical sort of thing. I honestly, so that's my disclaimer. I'm a noob and I have no idea what I'm talking about, and nothing I say should be construed as investment advice. And yeah, so don't take whatever I say and do the opposite, but we should have fun. Okay. So does anybody on the call, has anybody ever traded options, or has any idea what options are? Stock options. Specifically. Okay, cool. That's fine. So options are a financial derivative, and I want to point this out because I think it's worth mentioning. 10, 15 years ago, we, the plebeians that we are, would never have been able to trade options. It was limited to the professionals, the guys who actually worked literally on Wall Street. So this is an advent of the internet, or an invention, kind of. The fact that you and I can do this stuff is only possible because of technology. So it's somewhat relevant, and also I'm going to try to go into the math nerdery here, because that's what's cool about it to me, is it's all probabilities. So if you understand probability, if you understand risk, if you're good at math, you're 20 times more qualified than you need to be to make money at this stuff. It's stupid simple because of a couple of guys who figured out a formula a long time ago that we'll talk about in a minute. So what are options? Basically, they're a derivative, they're a financial instrument, and not so. The concept of trading stock is simple, right? You buy shares, you sell shares. Not all stock has options around it, but most stock, you can buy Apple options and sell Apple options. You can buy Netflix options and sell Netflix options. Most of the big names are going to have options around their stock. So there are 2 types of options. A call is, it entitles the buyer to buy stock on or before a certain date for a certain price. And generally we're talking about lots of 100, right? So if you buy a call option, you have the right to buy 100 shares. If you buy a put option, you have the right to sell 100 shares of that stock, okay? This is the basics of options here. The the buyer of a call has the right to buy stock. The buyer of a put has the right to sell stock, and the seller of a call has the obligation to sell stock. The seller of a put has the obligation to buy stock. Okay. Now, when I demagoguery, nice. I like it, PBX. That's awesome. All right. So when I use the word obligation, I need to note, because it's worth noting, that most people, like, we kind of have to understand the motivations that people have for buying and selling options. The vast majority of people who are buying and selling options are doing it not because they want to actually buy or sell the stock at that price, but because options are a form of leverage, and trading them, we can, like, so if I have assumptions about a stock that it's, say I think that Apple's going up because it's got earnings soon. Apple's trading at $128 a share. I don't have $12,800 to buy 100 shares of Apple stock, you know, if I wanted to take advantage of that small percentage move. But maybe the 130 put for a month out is selling for like $2. I do have $200 I can risk on the idea that Apple's going to be going up, right? So that's one of the motivations that people have for the majority of the motivation that people have for trading options is they're using them as a form of leverage against stocks. So they're, you know, that's what you have to understand when I'm talking about you have the obligation as a seller of an option to actually come up with that stock. Fewer than 10% of all options traded are ever actually exercised. And so a little of this, I'm thinking, might be going over some people's heads. Does anybody have any questions so far about what the hell I'm talking about?
So what does that $200 earn you if this price does get hit?
So, well, you would turn around and sell those options again. You would essentially be hoping that, so I'm probably not going to get into the, I was intentionally leaving out like the Greeks and a discussion of beta, delta, theta, and what they call the Greeks options traders, but essentially a delta is the measure of price sensitivity of an option at a particular strike price with regard to the price of the underlying, right? So if Apple's currently trading at $125, you think it's going to go over 130 by June, and the third Friday of the month is the typical day for monthly options, okay? You might buy 130 calls, and you're not really hoping to buy the stock at $130 a share at that point. You're hoping that, like, because those 130 calls will scale pretty much on a 1-to-1, so the delta will be near 1 when that stock goes up. So even though you've only paid $200 for that call, the price will rise on a 1-to-1 basis. So if Apple goes up $1, the price of that call will go up $1 because it's so close to the money. Okay? So in other words, you would collect essentially all the profit you would if you had bought $12,800 worth of stock by only paying $200 for that call option. Conversely, so the risk-reward equation is well established. So why wouldn't you just always buy options? Well, if the stock doesn't go up, and if you had just bought $12,800 worth of stock, you would still have that $12,800 worth of stock even though it didn't go up, right? If you had bought a $200 130 call option, you'd be out that money. Like that, it would just expire worthless, and that would be it. You wouldn't have any stock or anything to show for it. Okay? Does that kind of answer your question?
Yeah, that helps a lot. Thank you.
Sure, yeah. So, I mean, and we're going to get into some of that because I wanted to talk about kind of the guts of what an option is. And, you know, all this stuff is actually, at its core, very simple, particularly if you're good at math, but a lot of it is jargon. And I want to kind of clear most of that up. So when I talk about there are certain components of a stock option that make it what it is, okay? So the strike price, it's the agreement price of the option. So if I say I have Apple 130 calls, that means their contracts to buy Apple stock at 100 shares of Apple stock at $130 a share on or before the date. So if I say I have June 130 calls, it would be on or before June 19th, which is the third Friday. Now there are lots of stocks that do have weekly options as well, so you kind of have to specify which week in June. But if somebody just says I'm long a June 130 Apple call, then that's all the information you need to know exactly what that person is talking about, like when that option expires, what the strike price is, which stock it's for, you know. So the strike price is that agreed upon price that you will buy or sell the stock for. Okay. The premium would be the price of the option. So that's what you actually pay. If you buy that June 130 put for $2 a share, the premium of $2 a share, that's $200. That's actually kind of an extreme example. I doubt June 130 Apple puts are actually trading that high right now. I'm curious. Let's see. June 130 puts are, or June 130 calls are actually they're 277, so $277. Anyway, so that's the premium. That's not ambiguous, right? So there's the strike price. The premium is what you're paying or collecting for the option, depending on whether you're buying or selling. The expiration is that core component of an option that determines the last day on which the option can be exercised or traded, right? So if you had a May option, it actually expires today. It actually expired like 15 minutes ago, because the markets, options markets, the Chicago Board Options Exchange is open from 9:30 Eastern to 4 Eastern, Monday through Friday. Okay, so after talking about the core components, the guts, we start to get a little bit into the theoretical with intrinsic versus extrinsic value of an option. Okay, so it hopefully the way I explain it, it will just make intuitive sense, but let me know if there is any ambiguity here. So if a stock is trading for $125 a share, then a call option with a strike price of $120 has an intrinsic value of $5. Pretty simple, right? I mean, if I were to exercise those right now, I would make $500 profit. If I had, you know, call options with a strike price of 120 and a stock is trading for 125, I could literally just flip that in a few minutes and make $500. That's intrinsic value. Okay? Extrinsic value, because that would never happen. Like I would never be able to just buy an option for less and you know, and exercise it for less than it would the actual market price of the stock. It wouldn't make any sense. So the extrinsic value is the difference between the strike price plus the premium and the current market price. Okay, so, and I think this is easier to understand when we're just talking about being long calls. So that's what the context that we're talking about here. So our above option has a premium of $6.20. So the extrinsic value is 126.20 minus 125. That's $1.20. That's essentially what you're paying to hold on to that option. Okay, and most of the extrinsic value is time value because options are time bound, right? If I buy a June option, then the price of the stock has to move in the direction that I hope it'll move because time is working against me. Okay, is all this clear so far? Does anybody have any questions? Have I lost everybody? Right. Okay.
We're still with you, Drew.
All right. Just making sure. All right, cool. It's hard, you know, you don't get a lot of feedback. So.
I know.
Talking at my screen here. So just a few pieces of jargon. When I say long, that's, you know, when I say I'm long a stock, that means I own it. I'm long 100 shares of Apple. I own 100 shares of Apple. Okay. When you're short, it means you don't. It's the opposite of that, and this is where I think some people, or it's easy to get confused, right? Because you can sell things on the market without owning them first. Okay, so when I say I'm short 100 shares of Apple, that means that I borrowed 100 shares of Apple from somebody else and I sold them. And I hope that Apple goes down so that I can buy them back to cover myself. And I'll end up with a profit. Okay? And it's the same concept when we're trading options. You can be long or short options, whether or not you own the underlying, whether or not you own the option first. Okay? Hopefully that's a simple concept, but if anybody's confused about it, just speak up, because it seriously is like there's nowhere else in the world but the markets where you can sell something that you don't own, I think, right? But anyway, so the next part, and the actual term for this is moneyness. I'm not making this up, and I think it's the best thing in the world that it's an actual thing. This is called moneyness. The moneyness of an option, whether it is in the money or out of the money, means, so if I have an Apple May 125 call, is that in the money or out of the money? Okay, Apple's trading at $128.75 as of close. What does that mean? That means that 125 call is in the money because it's $3 less than what I would pay if I were just to buy Apple stock, right? It's $3.75 less. So it means the opposite for a put, right? So if the option strike price is lower than the market price of the underlying in the case of a call, or higher than the market price of the underlying in the case of a put, then that option would be considered in the money. Okay? So pretty simple concept. Is it unclear to anybody? All right, sweet. So naked versus covered is just basically, not only can you sell things you don't own, but you don't actually have to, like, so I can sell you a call on Apple stock without owning the Apple stock. And that could be dangerous. Think about the implications of what could happen. I sell you an Apple call at 130. Apple shoots up to $150. I would have to cover that. I'd have to buy Apple at $150 a share, and then I'd have to sell it to you at $130 a share. So your losses will add up quickly. You know, there's no, you're theoretically unlimited risk there, because a stock could go up infinitely. Whereas in the case of a naked put, a stock can't actually be worth less than zero. So you do have a technically limited risk there, but it can add up to an awful lot. So that's the differentiation between naked and covered, is just how much risk you're really taking by being short that option. Okay, and I think the most important thing to talk about before we get into the various strategies for trading options is implied volatility. And I would be lying if I said I fully understood the equation behind implied volatility. It is a mathematical model that is routinely validated based on market performance. I mean, it's been continuously validated to be within a few percentage points margin of error for the majority of the market. So essentially, if you see implied volatility is usually expressed as a percentage. And that percentage can be thought of as the swing around the current market price. Okay, so if a stock has an implied volatility of 50% and is trading for $100, that means it could go from $75 to $125, basically. Or am I doing the math wrong? Somebody stop me if at any point I get simple math wrong, because I'll be really embarrassed. But are there any questions on any of these things? Sweet. All right. That's good. I'm going to assume 100% comprehension then. Okay. But I don't want to just talk over slides either. I want to get through these few things and then move on to a couple of cool pieces of software that I use I have also some like Python scripts, or I think they're Ruby actually, that I've written to interact with TradeKing's API and do some scans. And I probably won't have time to get into those today, but that's fun too. And I'll explain like some of the limitations of the software that I've been using where it doesn't kind of meet my needs and why I've felt compelled to script a little bit. So I think the gateway drug, so to speak, to selling options or trading options in general would be perhaps the covered call, because I think this is one of the easiest concepts to grasp as to why you would feel compelled to trade options. Okay, so a covered call is when you buy 100 shares of a stock and you simultaneously in the same transaction you sell the right to buy them from you for a premium. Okay, and by doing so you reduce your cost basis. So I'll give you a practical example. In April, Apple was set to. I'm going to talk about Apple stock a lot. It's a really good example because they're in the S&P 500. They're a huge cap company, mega cap, but they're tech, and they consistently beat expectations and earnings, and they've had a really good bullish run for a while. It's a pretty good, solid, stable stock to use as an illustration. So I apologize. I may come across as an Apple fanboy. I kind of am. I think that they can do no wrong right now, but hopefully I'll be given some leeway there. So in April, towards the end of April, Apple was releasing the watch, and they had earnings coming out as well. And Apple has consistently beat earnings reports. Earnings tends to be a pretty high volatility time. People don't know what a stock's really going to do. Is it going to shoot up? Is it going to go down? But it tends to do something around earnings for most companies, whether they meet or beat or don't fail to beat earnings. So I knew that like it was literally like 3 business days difference between the Apple Watch coming out and earnings. So I knew that the stock was doing something, but analysts were way too bullish for me. They were saying like, oh, Apple's going to 150, and I'm like, I think Apple's going to 150 like in 2017, like not this quarter, So I said I'd like to be long that stock, but I don't think it's going to take that crazy meteoric rise that everybody thinks. So what I did was I bought it for, I think that my cost basis was $125.90 a share, but I simultaneously sold the right to buy those 100 shares from me on 30 days. I think the next month, like actually today. So the first call I took out on Apple was for May, which would have expired today at 135. And looking back, hindsight is 20/20. I probably should have done 130 calls, but that was a little rich for my blood at the time. Like I was looking at the math, and I said, well, if I sell 135 calls, I can sell those for $1.40 a share, and that reduces my cost basis to $24.50 a share. So if I had to sell today, at that point, like 30 some odd days from now, I would be looking at an 8% profit, for the month on like $13,000. So that's a pretty good deal. Like I'll take that. I'll take that any day of the week. That's worst case. I make 8%. Best case is the stock doesn't go up to 135, and I just keep the premium. My cost basis is reduced, and the next month when those calls expire, I turn around and sell another call, and reduce my cost basis further. Right? Well, it turns out that Apple beat earnings just like everybody expected. But the crazy thing about this is nobody has any special knowledge, right? They read the same news. So everybody knew the Apple Watch was coming out. Everybody expected Apple to beat earnings. That was already baked into the price of the stock, so it didn't go over 135. In fact, it dropped a little bit after it hit 130. And a couple of weeks ago, I bought back that call, and I kept about $1 of profit in there. And I turned around and sold another call. At this point, I think my cost basis on Apple is like $122 a share. So anything above $122 a share for me is pure profit on Apple. So that like, does that make the light bulb go on for anybody about like why you would use options? Or is there any confusion about what I was just talking about? Okay. Any feedback at all? All right. I'm gonna move on to a couple other strategies that we have. I'm gonna just make sure I'm still in the Hangout, right? Okay, cool. Sweet. So the most basic thing you can do, so remember, we could buy or we could sell options, whether we own them or not first, okay? So a naked put, naked call, you say, I think there's no way, or it's very, very unlikely that this stock, so I'm looking at Twitter right here, and I'm not sure when I took these screenshots, but say this interface, this program is called Doe. It's actually a web app that I'm going to show us. I'm going to go through later because it's actually pretty neat. Some of the calculations that it gives you, and so if I sold this 35.5 put on Twitter, which hindsight is 20/20, right? Let's see where Twitter is. Twitter's at 37.10, so we would have been safe with this. If I sold this and noticed that it expires today on Twitter, I would have had an 88% chance of winding up making profit, not ever having to. So I would have started losing money when the stock dips below this little margin here, which is the difference between the strike price of 35.5 bucks and the premium I collected, which would have been $17, right? The 17 cents times 100 shares is $17. That little slice right there is where I would, still have made money. Right at the edge here is where I would break even. So that's all you're doing when you're selling a naked put. You're selling price insurance. You don't think that this stock is going to go below 35.5 bucks. Okay, and it's converse when you're doing a naked call. You're saying that I don't think the stock is going to go above whatever, $42, $43, $45. And if you look at this, so this is the probability curve of the price of this stock with respect to its implied volatility. And these bands are the first standard deviation, and these guys on the outside are the second standard deviation. So we know that this represents about 84% of all probable outcomes, and then these outer bands, you're at 98% of all probable outcomes once you get to the second standard deviation. Okay, so prob and stats will serve you well when you're trading options. That's really all you have to fall back on. But any questions or comments about that? Any of what I just talked about? All right, cool. So, and probably, hopefully, anybody who's engaged and listening is already coming up with some strategies that you could kind of use for trading options, because we've kind of already talked about how you can buy or sell a put or call. So there are essentially 4 different angles that we have to approach this, right? So hopefully by now you've figured out that when you're buying a call, it's a bullish assumption. You think the stock is going up, and when you're buying a put, it's a bearish assumption, and you think that stock, that underlying, is going to go down. So you can do a straddle as well, which is where you think that the stock is going to move and you don't know which way. And when you look at how the prices of these options change in relation to the price of the underlying, you will make money regardless. As long as the stock moves enough one way or the other, you will make money. But it just has to move outside these bands. So in here is this would cost you almost 200 bucks, right? To straddle Twitter at this ratio would cost you almost 200 bucks. 1.99 times 100 is $199. But you'd start making money if Twitter got above 42.7-ish or below 37. So that's something that a lot of people will do. They'll take a straddle during earnings. It's kind of like going to the roulette table and betting on a color. And it's not too much better overall than just buying a stock, okay? Because our base presumption when we're talking about the probabilities in stocks is we have a 50-50 chance of going up or down, right? And a lot of people will try to use some sort of edge. They'll a news event or some sort of information that they think not a lot of people are trading on. But ultimately, I think we can all agree that for the most part, you can't really predict a stock's movement. Like, it's up or down, and you don't really know which. So the cool thing about options is that it gives us this opportunity to have better than 50-50 odds, right? This is a terrible example because it has less than a 50-50 chance of profit. So if the stock just doesn't do anything, this bet's going to fail, and we'll be out $200. Conversely, we have a strangle, which is where you think like the price of the stock isn't going to move too far, and that, like, strangles are most of what I sell, or actually iron condors, but we'll get into how it's basically a limited risk strangle. Because if you look at this, this has a really, really good probability of success, but if the stock did start going way up or way down, you'd start to lose money fast. So, and I mean that's rare, but it does happen. 2008, 2001, it happens. And I mean, even Warren Buffett got bitten during the 2008 crash, so it happens to the best of them. So yeah, that's a strangle is the opposite of a straddle, where you're essentially confining the price. You're putting a collar on it and saying, I'll keep 100% of my profit in this window, and I don't start losing money until the stock really drops or goes way up. Okay. Any questions about any of the strategies we've talked about so far? All right, sweet. So, as a companion to what we've already discussed, wait, okay, we already have, like, hang on. Sorry, I'm reading the tea time chat. I agree, Burns. Yeah, totally. Dude, yeah, to do this in the 80s, you definitely would have needed cocaine. Cool. Okay. Good conversation happening in tea time. So a spread is, so there's two components to a spread, right? You're generally buying and selling two of the same type of option. Okay, so in this case, this is a put spread, and it's the 3736.5 put spread. So what am I doing here? It's just like selling a naked put, right? Except that I am limiting my profit and also severely limiting my potential loss, right? Because the maximum I could lose here is the difference between those two puts minus or less the credit received, okay? So, and this isn't a bet that I would actually take. I wouldn't take anything on Twitter right now because it's garbage, but if you look at this, so the difference between these two strikes is 50 cents or $50, since we're talking in increments of 100, and I would be collecting $11. So 50 minus 11 is $39. That's the absolute maximum that I could lose on this. But I would collect $11 right away today, and there's a 74% chance that I would make money. It's not terrible, but it's not like, if I were maybe a pro and I could do commission-free trades, I'd take trades like this. I'm not. I have to pay commission, and so that $11 trade would turn into like a, $3 profit or something for me, and it's totally not worth it when you're talking about options commission. So I want to just to point out as an aside that I'm using these as an example, but it doesn't necessarily mean I think it's a good trade. I'm just kind of using them as illustrations. Okay, so that's a spread. Now, if you remember, I talked about strangles. You could do a spread on either side, right? So you could actually limit your risk with a strangle, and that's what we call an iron condor. So there are we got all kinds of terminology and jargon going on. We got iron condors and jade lizards, and they're all some combination of these very basic, very simple strategies that anybody can understand. That we just kind of given them shorthand, the jargon. Okay. Oh, dude, you're seeing my Windows is not genuine. That's awesome. Okay, I should have used my other monitor, but I do have a genuine copy of Windows. I actually bought it from Lehigh. It just doesn't believe that it's genuine. All right. Cool. So, does anybody have any questions so far? No? Nobody? Somebody just unmuted their mic. Who was that?
Yeah, I think we have a few more minutes here. We can go ahead and start wrapping up and let us know. Make sure you get all your questions in. I see a side conversation happening in tea time, which is pretty funny. So make sure
we should. I know. I've been going on for a long time, and I knew that this would be long. That's why I wanted to go first. Yeah, wife's bugging me. So I could make this a two-parter because I really wanted to get into the practice of it, but do we have questions? Because I think that's honestly the best way to illuminate this a little bit. Did I lose everybody? I bet you I lost everybody. Paul was with me in the beginning.
Still here.
All right. Are you bored, though?
No, I'm just thinking about my talk.
Oh, all right. Yeah. I feel you there. Well, I'm going to be very rude and leave after mine's done because I have to get on the road. I apologize to all my fellow tea timers, but I usually try to participate.
Hey, Drew. I was just wondering, so you said that at the beginning, if you know the math, if you're good at math, you can make good money with this. How's it working out for you? Is it more of a hobby? Do you just enjoy it, or are you actually making some good money with this?
It's good question. Great question. So can you guys, let me see here. All right. Let me see. Can you actually see my Thinkorswim window there, that I just put up? Or are you still seeing Google Hangouts?
I see your Thinkorswim.
All right, sweet. So this is a paper money fake trading account that I started a month ago when I was going to first do this talk, right? And I made a bunch of trades in anticipation of this talk to illustrate what I'm talking about, okay? And they're trades that I would normally make, especially if I had $100,000 to trade, but my account's not quite that big. So you can see what the account's worth now, which is this number up in the 205, 226. So, I mean, I've made over $105,000 in fake money in a month. So, yeah, I do all right. But this is and again, it's not necessarily like the highest risk trades necessarily that I would make, and also take into account I bought 2,000 shares of this garbage. This is a triple leveraged bear shares gold miners. Like, this goes up when the market goes down, and the market's been doing nothing but going up. So I lost a bunch of money in some of my hedges here. Like, these were things that I took out as hedges against market movement, and I still managed to double my money with trading options on the rest of this stuff. So it's, yeah, you if you understand probability and risk, and you understand, like, you don't get emotional about it. This is the most important thing. Is like, I have 4 basic rules for my strategy. If I stick to the rules, my returns are great. If I get emotional or panic or something like that, I usually screw myself. So I've learned that lesson, and I stick to my rules. Does that answer your question?
Yes, thanks.
Yeah, right on.
So when you use fake money, does it treat it exactly like real money? It doesn't really affect the market, right? Because it's fake money.
Right. It doesn't affect the market, but like the cool thing about this, so anybody who wants to just play around with this, I recommend go to thinkorswim.com, download their client. You can sign up for a paper money account. It's free. Okay. And then you can get a real, like, you just screw around with it and see what the actual effect on your account is, right? So the cool thing that I think, because this is a lesson you learn right away when you're using real money, is just because something looks great on paper as a trade, that doesn't mean anybody's actually going to take you up on it, right? Because if it seems too good to be true, like if you're making 1,000% return and risking like nothing, then nobody's going to buy that from you, right? It doesn't make any sense. Thinkorswim, it will not actually fill junk orders for you, right? So all this stuff that I did, these are orders that would actually be filled. Like somebody would have actually bought this from me. Okay?
Oh, okay.
Yeah. So I highly recommend like screwing around with it there, because like the metric that it uses to tell whether you would be filled on a trade is like if the bid-ask spread for those options is huge, like 20 cents wide, then you're not going to get filled in the middle, because that probably means that it's mispriced. So it takes that into account, and I can't speak highly enough of that. Just screw around with paper money, and we will talk about the mechanics at next tea time, because I don't want to take up any more of everybody else's presentation time.
Okay, well, thanks so much, Drew. You guys have more questions, you can paste them in the IRC tea time. That's been really, really helpful. It sounds like there's enough interest for another talk. So thanks very much, Drew, and we hope you enjoy your trip and everything.
Thanks, man.
Anytime. So next up we have some people who've recently visited, went to PyCon 2015. So Andrew and Barbara, do you wish to share that experience?
Yes. So I'll go first. Are you going to give me presenter, or?
Yeah, I think you can pretty much just
okay.
take it yourself. Yeah, you could do screen share, and you should be okay with that. It's in the left-hand corner. You'll see a green icon that says screen share.
Okay. Are you seeing a colorful slide?
We are.
Excellent. Okay. So 3 of us went to PyCon 2015 at the beginning of April. PyCon is the largest annual Python conference. This year, I heard that we had around 3,000 attendees, which is, the conference hits a new high every year because the community and user population is always growing. This year's conference was held in Montreal, which is my hometown, so I really looked forward to that, because it was a chance for me to visit family as well as going to a fun conference. PyCon has a whole lot of stuff going on. There's a program of talks for the 3 days of the conference itself. Before the conference, there are 2 days of tutorials. There are open space sessions where you could just sort of schedule your own thing. There's a vendor expo, a job fair, startup row, and a poster session. So lots of things. It's just sort of a frenzy of activity for those days at the conference. So I'm going to talk a bit about the stuff I did. So I actually still have commit access to the core Python interpreter because I worked on it a lot in the 90s and early 2000s. And everyone with commit access gets invited to an event called the Python Language Summit, which is held before the conference on one of the tutorial days. And so invitations go to people with commit access to CPython, and also to people who work on sort of altered implementations, things like PyPy or Jython or IronPython. And we also invite sort of an interesting selection of sort of random other people who teach or are notable contributors to some other project. And so the Language Summit is a very technical session. It's the one place where all of the core developers are sort of in one room and can talk over proposals, plans for the next release, and all that sort of thing. So I'm not going to go into great detail about what we talked about at the Language Summit, because this year there was something new. There was a reporter present, Jake Edge of Linux Weekly News, and he wrote pretty detailed summaries of each session from the day. And so if you follow that bit.ly link, it'll take you to the Linux Weekly News site linking all of these stories. Some of the things discussed included one guy presented a new implementation he's been working on called Skython, which is a completely new C implementation of Python that has mark sweep garbage collection, no global interpreter lock, and a completely different C API, so it's not compatible at all. And so that's experimental work he hasn't released yet, but so he talked about what he's been trying to do, and people asked him questions about it. Other people presented their own systems. Trent Nelson talked about his PyParallel, which is another system for sort of trying to get parallelism without running into the global interpreter lock. Guido van Rossum, the creator of Python back around 1989, gave a presentation on type hinting, which is a feature he wants to add to Python 3.5. And he sort of replayed his Language Summit talk as a keynote later in the conference. So you'll be able to watch that on YouTube if you like. Steve Dower, who's the new maintainer of Python at Microsoft, talked about the state of Python on Windows and asked for feedback on various changes he wanted to make to installers and that sort of thing. So one wonderful thing about PyCon is that pretty much everything gets recorded. Almost every talk and tutorial is available on YouTube. So the top link you should be seeing on your screen points to the full playlist. And so you can scroll through that and look for things that are of interest to you. The three of us who went, me, Barbara Charette, and Domen Kozar, also wrote up some notes and suggestions that we put in our internal wiki, and that's the bottom link, which takes you to those notes. And so again, I'm not going to go through a big, long, detailed list of the talks I liked. I do want, however, to highlight this year's keynotes, which were all very good. I usually hate keynotes because I'm a cranky kind of person, and I dislike having the topic sort of decreed for me. I like having the choice of multiple talks. But this year's keynotes I really liked. Gabriella Coleman, who is an anthropologist at McGill University in Montreal, talked on the history of the hacker group / mischief group Anonymous. Catherine Bracey of Code for America talked about ways that software developers can have an impact on their local community by building apps or hacking on public data. And Jacob Kaplan-Moss, one of the primary Django developers, gave a keynote on the myth of programmers being either completely exceptional or utterly terrible. And his talk made the rounds of social media immediately after the conference, and I saw a fair bit of discussion of it. So I recommend all of those keynotes if you're interested in any of those topics. And the last thing I think I'm going to talk about is so one aspect of the conference is open space, where people can sort of arrange their own sessions and try to find people who share their interest. So I went to a journalism birds of a feather session that turned out to be 3 people. Me, someone from the Texas Tribune, which is a nonprofit newspaper that covers the Texas legislature and sort of the political scene at the state level, and someone from the National Journal, which is another political journal, one that's in the DC area, I think, and it's sort of aimed more at lobbyists, covering what's going on the Hill. And so the three of us chatted a bit about the various things we're working on. I talked about our move to smaller web services and our introduction of things like mobile apps for journalists, things like Hummingbird. And so I didn't learn that much from the conversation, but it was really interesting to sort of hear what other people are working on. National Journal, for example, does ad demographics based on which articles you read. And so that's available to them to flight ads. And I don't know our ad system well enough to know if we have that capability, but it's an interesting thing to think about. I also learned they actually also have PageGen, but slightly different. They pre-generate things ahead of time, but instead of generating HTML and pushing it into Akamai as we do, they generate MongoDB documents. And then their template rendering is just sort of very, very, very dumb and consists of pulling out Mongo documents and substituting them into templates. So that's an interesting variation on what we do. Attending this kind of gave me the idea that maybe I should try to arrange a Washington, D.C. area sort of session for people like us. DC has lots and lots of newspaper people, Washington Post, Washington Times, PBS, USA Today, and so some sort of journalism developer BOF session would maybe fit nicely into the local user group. So let me go back to the list of videos, and here I think I'll turn things over to Barbara, who can talk about her experience of PyCon.
Great, thank you so much. I didn't actually put together slides. I think what I'm going to do is switch over to that intranet page that we talked about, or that Andrew talked about, with all of our video recommendations. Okay. Give me just a second. All right, are you guys seeing that page?
Yeah, we're seeing your screen now.
Excellent, okay. Yeah, I didn't actually create slides, but that's because, most of my PyCon experience this year, as it has been for the last 3 years now, was about young coders. And even though we get releases to take pictures of the kids as they're learning, we really don't have time to. So I don't have a lot of photos from that week. But as you can see on this internet page, I do have a couple of notes about the talks that I really enjoyed, so I won't go through that here. What I do want to talk about is young coders, though. I don't know how many of you have heard about this program, but this is something that we've been doing. This was our 3rd year. I think it feels like we've been doing it a whole lot longer. I developed the curriculum for this class, but I teach it every year at PyCon with Katie Cunningham, who a lot of you might know. She used to work here at Cox. We also do it at regional conferences through the year. We've done it at PyOhio. She's taught it at PyTennessee a few times. It's sort of grown legs of its own, and it's being taught in a lot of places now since we introduced it in Santa Clara a few years back. The class takes kids from ages 12 to 18, although occasionally a few kids that are younger than that sneak in. It's ostensibly a beginner class. We start with the basics. We spend half the day talking about strings and math, booleans, variables. We get into lists a little bit, and then talk about functions, how to write functions, and a little bit of logic. And then we end the day, editing and playing games. We use PyGames, which is installed locally on the Raspberry Pis, and that's the other thing that's really awesome about this class. We have a budget to buy enough Raspberry Pis to teach on, and then we send the kids home with them every year. They take the Raspberry Pis along with their imaged cards and power supply. I think that this year we had a kit that included all of those things plus a kit. So we're really fortunate that the PSF and PyCon organizers are willing to pony up the money for this for the kids every year. It's it's pretty exciting. This year we probably did a little more than we should have. We had 40 kids for each class. Oh, and I should mention that we did two classes this year, as we always have. The first year we just did two back-to-back. This year we did one in French, another in English. We have two wonderful French-speaking teachers, Montreal locals, who come in and teach the beginner class. So that was what we did this year and the year before, of course. We've been in Montreal for 2 years. Next year, we are planning on introducing an intermediate curriculum, and that's largely because Katie and I have gotten a little bit bored teaching the beginner class, and we have quite a few TAs who I think will probably step up. I don't know if any of you are familiar with Richard Jones and Naomi Cedar. There's a good chance that they will be teaching the Young Coders beginner class next year, and Katie and I are going to work on an intermediate class that has kids building their first web project, probably building a game. It's still in development, so I'm not exactly sure what we're going to teach. But anyway, if you're curious, the beginner curriculum is on GitHub. In fact, I have a tab open here. I don't know if you can see that, but I'm on GitHub as Mechanical Girl. The Young Coders tutorial, you'll find that right at the top of my account if you go there. It's a repository full of lots of garbage, but mostly useful files with presentation pieces that we've used over the last few years. I recommend just going straight to 2015 because the first couple of years were not that great. But yeah, if you're interested in the curriculum there, take a look. And of course, if you've got any questions about the class, or if you're interested in helping to teach it all, or if you want to teach it locally, it's something that we encourage. I'm happy to have you, take this beginner curriculum and teach it in your own community. I feel like it's something that any user group can do. But anyway, yeah, go ahead and ping me online. I'm Mechanical Girl. Usually in @all or sorry, in the all channel and the platform channel. And that's it. Looks like we've just hit 5 o'clock, so I think that's all.
So if anyone has a quick question or two, we're happy to answer them.
Is PyCon in Montreal again next year, or is it over now?
Oh no, it's going to be in Portland next year.
Yeah.
Yay, I know. Actually, Andrew, I have a question for you. Who was there from the Texas Tribune? I worked there for, gosh, almost a year right before I joined Cox.
The person's name is probably in my notes, but I don't remember off the top of my head.
Okay.
Right.
Did you all do any sprints?
I did not. I spent 4 days either teaching or setting up, preparing a classroom to teach. So I was a little exhausted by the end of that.
So I actually stayed around for the CPython sprint and sort of worked on various small things, and actually ended up sitting at the Microsoft table with Steve Dower and some other people. So I got to try out a Surface. But so I stayed there for 2 days and then headed back to my parents' house for the rest of the week.
I was actually curious to know more, or to hear more about the global interpreter lock workarounds and the two that you mentioned.
I think you'd probably have to I really recommend looking at the Linux Weekly News summaries, because they're much more detailed than my increasingly faint memory can be. I think Skython is a re-implementation that presumably keeps locks on every single piece of data as opposed to having one big one. And PyParallel, I found it kind of mystifying because it's not really clear to me how it works. I think it sort of works with shared memory and sharing Python objects between processes, but that wasn't really clear to me. So yeah, I would suggest reading those summaries instead, which will be much more complete.
Okay, I was just curious about your impressions, because I know that there have been a few attempts in the last decade or so to work around the global interpreter lock, and most of them, from what I've read, were met with, simple Python script writers being really mad that suddenly their programs were running significantly slower when they only need one thread.
Well, I mean, to some degree, I think you can be free of the lock now if you want to use Jython or IronPython, which is Python atop Microsoft's CLR. And I think PyPy in certain modes also supports not having a lock. The problem is, part of it is the difficulty of changing implementations, and part of it is that if you have to lock every single thing, you now have even more locking overhead. But it's not really a field that I or an area that I follow terribly closely, because the sort of thing I do is never really affected very much.
Right. Yeah, it's not something I ever run into in my day-to-day life. But back in college, I did some compiler time parallelizing loops optimization research with a professor, and so I've always been very interested in Python eventually getting not only past the global interpreter lock, but also speedily doing so. So when my ears kind of perk up whenever that topic comes up. So I'll definitely check out the links. Thank you.
Yeah, and I posted the links in the chat. I'll post them in IRC too. This has really been helpful. I love to see the images. I remember when we went to, Andrew, you remember we went to PyCon and in Montreal, and it sounds like it was in the same place, Quebec, and it was really beautiful as far as the town and what you see and places to eat. So it was almost like a vacation resort just going there. So I really enjoyed that, and it was a pleasure to see that they had it in the same place this year. Or was it the same convention center, Andrew and Barbara?
It was.
Okay.
The conference at this point is large enough that it tries to stay in the same location for 2 years, so that so that the organizers sort of get familiar with the venue, and you don't need to do a location search every single year. So Portland, I assume, will also be 2 years running, unless the first year is massively disastrous for some reason.
Yeah. Oh, okay. Well, yeah. You guys taking me aback with your talks and your pictures, and for anyone who is thinking about going to PyCon, I definitely recommend it. One of the things a lot of people look forward to, and I don't know if they had it this year, were some of the Gary Bernhardt talks. Last year he gave one about JavaScript and the life cycle, and he kept calling it JavaScript, and it was just really funny, and he's one of the premier speakers at those events. Was he speaking at this one? Did he give any talks?
You know, I don't remember seeing him on the speaker list this year. I tried to get into as many talks as I could, but I don't think that Gary was there. Not this year.
Yeah, I haven't heard anything either. And the thing is, with him, he doesn't like his talks recorded, so you can't go back and watch them anyway. You have to kind of be there. But yeah.
I think Bernhardt actually gave the closing keynote, but unfortunately, I didn't manage to see it.
Oh. Maybe it was recorded, so we can check that out. I'm definitely going to check out the keynote you've mentioned, Andrew. I want to go back and watch that. Okay, well, I know we're over time, and that was very interesting. I'd love to hear about that, and then maybe we can all go to PyCon or do something later this year. And Paul, we'll have to get to your talk next time, so thanks for giving us some time to do that. We really appreciate that.
Yeah, that's fine.
Yeah, but we're interested to hear about that too. And are there any more questions before we close out? Let you guys have the weekend. All right, well, thanks everyone. Take care. Have a good weekend.
You too. Thanks, everyone.